So the next entity structure is an S Corp. And like I said, you can have an S Corp with one person as the sole shareholder in the S Corp. You can also have a partnership S Corp, which is an S Corp that has more than one party. So it's a little bit confusing. A lot of times when I ask what is your business structure, and they'll say, well, it's an LLC. Okay, an LLC is a state level formation. It doesn't necessarily have anything to do with your tax liability. An LLC can elect to be taxed as an S Corp. You're still an LLC, but you've done what they call an S election. So an S Corp is like a partnership. It's a totally separate tax return. Your income and expense goes on this separate S Corp tax return, and just like with a partnership, that net income gets split out between the different members of the S Corp, different shareholders of the S Corp, whether it's one or many. Let's say, for example, on this S Corp, you've got $100,000 of net income, 50-50, 50% goes on a K1, just like with a partnership, to this partner. 50% goes on that partner's K1 and flows onto their personal tax return. The difference with an S Corp is that net income does not get hit with Social Security and Medicare tax. So that can be potentially a huge tax savings depending on the net income of your business is saving on that Social Security and Medicare piece. So that $100,000 net income gets split out between the two people. You're going to be saving 15.3% of that net income in tax. So that's the self-employment tax that you're not paying. The catch, because there always is a catch with the IRS, is with an S Corp, you do have to go on payroll. So every shareholder in the S Corp that is a more than 5% shareholder must draw an actual paycheck. So with that paycheck, you do have your federal and state withholdings, you've got your Social Security and Medicare withholdings, and the matching Social Security and Medicare that your employer pays. And what that will do is reduce the amount of net income in your business because some of it's being paid out in payroll, and the savings is still on that net income piece. So if you've got your $100,000 net income business, right, you have, and of that $100,000, you pay $50,000 of it out in payroll, right? So the $50,000 that you pay in payroll has the federal and state and the Social Security and Medicare. The bottom line here, this $50,000 that's left over, that's where your savings is. That's where you save your 15.3% on the self-employment tax. So they do get you up here. You do have to pay some measure of Social Security, Medicare, but then this net income, that's where your tax savings is. So, and that can ultimately be a good thing because with the Social Security and Medicare, you're building up your base so that when you end up retiring, you do have a history then of having Social Security withheld from your pay. You're either doing it 100% here with the single member LLC or the sole proprietorship, or you're doing a portion of it here under the S Corp formation. So having that Social Security history can be beneficial depending on retirement age and things like that. But the immediate tax savings can be a real benefit to your business. And also another benefit of having the S Corp and being on payroll is not only do you save taxes on the bottom line there, but the taxes that you do end up needing to pay, you're already setting aside that in a paycheck. So just like when you had your W-2 job and you had a certain amount withheld from each paycheck, you're doing that as well under the S Corp. And so you're already prepaying some of your ultimate tax liability. Which having it come out over time rather than having one big lump sum at the end of the year can really help with your cash flow.